Have you ever noticed how prices in the market sometimes jump suddenly, leaving a gap on your chart? These gaps aren't just random. They're powerful signals called fair value gaps. These gaps have been my secret weapon for spotting high probability trades for years. But here's the problem. Most traders misuse them, leading to costly mistakes. Today, I'll break down exactly how to identify the best fair value gaps, share 5 hacks to boost your success, and reveal 3 advanced strategies I use daily. By the end of this video, you'll know exactly how to spot the highest quality fair value gaps. Let's get started. What is a fair value gap? Let's start with the basics. A fair value gap is a 3-candle pattern that reveals a sudden imbalance between buyers and sellers. Picture this. The first candle moves decisively in one direction. The second candle explodes further in the same direction with strong momentum. And the third candle hesitates, pulling back slightly. The critical detail? The high of the first candle and the low of the third candle don't overlap with the middle candle. That uncharted space between them, that's your fair value gap. Think of it like a power vacuum in the market. Prices surge so aggressively that one side, buyers or sellers, overwhelm the other, leaving a zone of untraded prices. Imagine a tug of war where one team yanks the rope so hard that the other team loses grip entirely. That sudden shift creates a gap, and the market always remembers it. Sooner or later, prices tend to revisit this gap, like a rubber band snapping back, to fill the imbalance. Traders watch for this retest, aiming to enter trades as prices bounce off the gap. But here's the catch. Not all gaps are created equal. Some gaps roar with potential, while others whisper false promises. Let's break down why. Weak gaps form during choppy, sideways markets. They're small, messy, and often get filled quickly, offering little edge. Strong gaps appear during clear trends. They're large, clean, and backed by momentum, like a freight train plowing through resistance. Traps lurk near key levels. For example, a bullish gap forming just below a major resistance zone is often a trap. Prices reverse before filling the gap. The secret? Learn to spot the difference. A high-quality fair value gap has 3 traits. It's unmitigated, never been tested by price. It's large, signaling a decisive imbalance. It aligns with the trend, like a gap forming after a breakout in an uptrend. In the next section, I'll share 5 hacks to filter out the noise and focus only on the gaps that matter. Let's turn these insights into profits. The 5 hacks to find high-probability gaps. Hack number 1, the untested gap rule. The best gaps are untested. If the price hasn't revisited the gap yet, it's fresh fuel for a potential bounce. Once the gap gets tested once or twice, its power weakens. Always ask, has the price already dipped into this zone? If yes, skip it. If not, it's prime for a bounce. Hack number 2, size matters. Bigger gaps mean stronger signals. A large middle candle shows a strong imbalance between buyers and sellers. Think of it like a tug of war. If one side wins decisively, like with a big candle, the gap they leave is harder to break. Hack number 3, location. If you see multiple gaps of similar size, focus on where they are. In an uptrend, gaps near the bottom of a price swing are stronger. In a downtrend, gaps near the top work best. Use the GAN box tool in TradingView. Drag from the swing low to high, or vice versa. The middle line splits the move and prioritizes gaps in the premium or discount zones. Hack number 4, avoid the trap zones. Never trade a fair value gap near a major support or resistance level. For example, a bullish gap under a strong resistance level is a recipe for disaster. Prices might reverse before filling the gap. Always check the bigger picture. Hack number 5, breakouts are your best friend. When prices smash through a previous high or low, a break of structure, gaps that form after this breakout are gold. They show the trend has momentum. It's like a runner gaining speed. They're less likely to stop suddenly. Now let's talk timing. The perfect entry is all about precision. Here's how I do it. First, focus on the midpoint of the gap. Prices often bounce here, not just at the edges. Use the GAN box tool to mark the gap's high and low. The middle of this box is your entry. Next, place your stop loss just outside the gap. If prices close beyond it, the setup's invalid. Finally, aim for twice your risk. If your stop is 50 pips, target 100 pips. Simple math, consistent gains. But let's take this further with 3 advanced strategies. Strategy 1, the second chance inversion gap. Even failed gaps get a second act. If prices break through a gap, that zone flips roles. A bullish gap becomes resistance. A bearish gap becomes support. Wait for prices to revisit this zone, then trade against the original direction. For example, if prices crash through a bullish gap, when they return, short it. But remember, this works once. Multiple retests mean the setup's dead. Strategy 2, the golden zone combo. Combine gaps with the Fibonacci retracement tool. Mark the gap, then draw Fibonacci levels from a swing low to high. If the gap aligns with the 61.8% golden ratio, it's a high probability trade. Why? These zones attract big players. When 2 tools agree, profits follow. Strategy 3, multi-timeframe confidence. Double-check your gaps across time frames. Start with a higher time frame, like the 4-hour or daily chart, and confirm the trend using the 200-period EMA. Only trade gaps in the trend's direction. Then, zoom into a lower time frame like the 1-hour or 15-minute chart, and use an indicator like the MACD to spot momentum shifts. For example, a 4-hour uptrend gap plus a 1-hour MACD bullish crossover equals your green light to buy. Even pros slip up, so let's cover common mistakes. First, avoid chasing overused gaps. If a gap's been tested 2 or 3 times, walk away. Second, never ignore the trend. Trading a bullish gap in a steep downtrend is like swimming upstream. It's exhausting and rarely works. Third, never risk more than 1 to 2% of your account on one gap. Patience beats greed every time. And there you have it, the complete blueprint to trading fair value gaps like a pro. Remember, gaps are your roadmap to imbalances, but they're just one tool. To truly master the markets, pair them with order blocks. Check out my video on combining these strategies for even bigger wins. If you found this helpful, hit that like button and subscribe for more trading insights. Before you go, do this. Open your charts right now. Find one unmitigated gap, mark it, and wait for that midpoint retest. When it hits, trust your setup. That's how winners are made. Thanks for listening and happy trading.